Business Finance Chapter 3. In Chapter 3, we look at financial statement analysis. One of the first things that the chapter talks about is making standardized financial statements. Standardized financial statements are where we turn our financial statements into common size financial statements. So in common size financial statements, this helps us to compare companies of different sizes within the same industry and helps us to look at information from year to year. For a common size balance sheet, all accounts are shown as a percent of total assets. Total assets would be 100%, and every other item is divided by total assets. In a common size income statement, all line items are shown as a percentage of sales or revenues, where sales or revenues are 100% and everything else is divided by sales or revenues to get to a percentage. We're going to look at this company's information for the entirety of Chapter 3, looks at this company called Proofrock. We have the financial information in our slides, and all of the ratio calculations we will be looking at will use this information. You can see here that this balance sheet has been turned into a common size balance sheet. So for a common size balance sheet, this is also called vertical financial statement analysis. Everything is shown as a percentage of total assets. Because total assets are 100%, total liabilities and owner's equity will also be 100% as they should equal. We can see that the amount of cash to total assets, the amount of each item in the balance sheet, and then the change that has occurred from one year to another. This is the income statement for the corporation that we are looking at in Chapter 3, using all of our ratio analysis on. And this is an example of the common size income statement for the Proofrock Corporation, where we are showing everything as a percentage of sales. Sales is 100%, and everything is shown as a percentage of that. When we look at a common size income statement, we can see how much a company has left over after paying their expenses, interest, and taxes for income on each dollar of sales. So we can see that net income is 20% of sales. This tells us that for every dollar in revenues, this company gets to keep 20 cents. And the remaining goes to expenses. When we're looking at ratio analysis, this allows us to compare through time or between companies. We can use ratio analysis internally and externally. We can use it to benchmark against competitors. We could use it to generate financial information about ourselves, and we can use it to look at trends over several years. When we're looking at each ratio, we want to know what the ratio is trying to measure and why that information is important. As I say in class sometimes, we don't do math just to do math. We're doing math for a reason. So we're doing this financial ratio calculation for a purpose. We want to measure something or we need information about something. It's not just to do math and generate percentage. These are the main categories of financial ratios, and we're going to go through each category one by one and talk about its actual financial ratios. So first we start with the liquidity ratios, or our short-term solvency. Do we have cash available in the short term to pay for our operations and short-term debt? Financial leverage ratios are long-term solvency ratios. Are we financially solvent in the long term? Asset management and turnover ratios. How well do we use our assets to do our daily operations to generate sales? Our profitability ratios, which are looking at how profitable we are, and then our market value ratios, which look mostly at dividend and market value of stock and book value of stock, where we're looking at what is the market value of our stock compared to our current book information. This is a table of the common financial ratios. This is not exhaustive. This is just the ones that are covered in this book. Also mentioned in the book is that not everyone calculates these ratios exactly the same way. So you might see some of these and think that's not the way exactly the way we calculated it in Principles of Accounting 2 when we covered financial statement analysis and looked at ratios. That is because not every financial statement ratio analysis looks at equations exactly the same way. There are standards, but some of them are a little bit different. One of the main differences we can see here is that we're not doing averages. So when we're looking at inventory or accounts receivable, it doesn't say average or for total assets. So it's just looking at one number and it's not calculating the average of 2 years put together. That's one of the main differences from this textbook to the Principles of Accounting textbook. This table is available in your textbook on page 63 and is a good reference for calculating ratios for this chapter. First, we're going to look at the liquidity ratios. The three main liquidity ratios are current ratio, quick ratio, and cash ratio. The current ratio looks at our ability to pay current liabilities with our current assets. The current ratio is calculated by taking current assets divided by current liabilities. We hope to have a current ratio higher than 1. In a healthy company, that current ratio should be higher than 1. From a creditor standpoint, we are looking for companies to have high current ratios because we want to know that they can repay any debt that they borrow from us. From a company standpoint, we do want a current ratio higher than 1, but we don't want it so high that it says that we're not using our cash well or leveraging our cash. We shouldn't have so much cash on hand that it's not earning money for us. We're better off doing short-term investments with our cash and earning interest on it. The quick ratio, which is the acid test ratio, removes inventory or other assets that can't very easily be turned into cash. Now, in this textbook, it just talks about inventory, but if we had prepaid assets would also be removed. So we take cash and accounts receivable, our quick assets, subtract out the assets that take time to turn into cash, and divide by current liabilities. What we can see with this company is that our ability to pay our short-term debt or our current liabilities is dependent on our ability to move inventory to a certain extent. That we don't have full coverage of assets to liabilities unless we are able to sell inventory. And the cash ratio is just how much cash we have on hand compared to our current liabilities or liabilities that are due within the next year. We can see here that that gets even lower when we take out accounts receivable and inventory, that our ability to pay all of our current liabilities greatly decreases with just the amount of available cash that we have on hand. Now, this isn't necessarily a bad thing because, as I said earlier, we do want our cash to be working for us. We want our cash to be invested in inventory or in short-term investment that is earning some kind of money. But we don't want our cash tied up in such a way that it isn't available to us to pay debt. How much cash you keep on hand is another ratio for another chapter. The next ratios we talk about are financial leverage ratios, or our long-term debt ratio. How long-term financially solvent are we? How much debt do we have on hand compared to equity? And we're going to look at these ratios again in future chapters when we talk about the capital structure of our organization. So we start with our total debt ratio. The total debt ratio is total assets minus total equity divided by total assets. Or we know, because of the balance sheet equation, that total assets minus total equity equals total liabilities. So it's also calculated by taking total liabilities divided by total assets. This means for every dollar in assets, we have 28 cents in debt. This also means that we have 72 cents in equity because assets equal total liabilities plus total equity. The total debt ratio plus the total equity ratio must equal 1, or for total assets. So if we have one or the other, we can calculate what the total equity is. Next, we look at the debt to equity ratio. So our debt is 0.28, leaving an equity of 0.72. So our total debt to equity ratio is 0.38 times. And then we have the equity multiplier. Our equity multiplier is total assets divided by total equity. Or this also equals 1 plus the debt to equity ratio. So the thing to notice here is that given any one of these three ratios, we can immediately calculate the other two because they all say a similar thing. The additional financial leverage ratios are times interest earned and cash coverage. What is our ability to cover our interest payments, which is an indicator of our ability to cover and pay for long-term debt. We take earnings before interest and taxes, that's EBIT, E-B-I-T, earnings before interest and taxes divided by interest. That gives us the times interest earned, which is 5.26 times for this company. We can also look at the cash coverage. Because depreciation is a non-cash expense, we add it back to EBIT, earnings before interest and taxes, and then divide that by the interest expense. That takes our coverage of interest payments up to 7.21 times. The next set of ratios we look at are asset management ratios. First, we have inventory ratios. Our inventory ratios is cost of goods sold divided by inventory. That cost of goods sold divided by inventory tells us how many times on average we sell out our entire inventory. Now, a tough thing about this ratio is if we have a wide variety of inventory, this is just an average. So if we think about a retailer such as Walmart or Target that has everything from groceries to electronics, this is an average of all of their inventory together. Some things are going to be selling faster and some things are going to be selling slower. So this is the entire inventory within the store sells out completely on average 3.18 times per year. We then divide that number. We take 365 and divide it by our inventory turnover, and that tells us on average how many days a piece of inventory sits on our shelf or in our warehouse or in our parking lot for a car salesman before it is sold. Again, this should be an industry specific thing because on average, some things are going to sell different than others. And we would look at industry to industry to tell whether that is a bad number or not. We know that cars are going to sit in a car sales lot longer than produce is going to sit in a grocery store, for example. The next asset management is receivable. So this is credit sales divided by accounts receivable, or how many times do we turn over our accounts receivable into cash every year? So 12.5 times is the number of times this company turns over its accounts receivable. We then take 365 divided by the receivables turnover, and that tells us how long on average it takes a customer to pay us cash for a credit sale. This tells us that it's approximately 29 days from the time a sale happens until we receive cash for this sale. If we were looking at the receivables turnover over a several years period, we would want this to stay steady or be decreasing in the number of days. An increase in the number of days shows us that customers are taking longer and longer to pay us for credit sales, which can start to indicate liquidity issues for our company or cash flow issues. We're not getting cash as fast as